Welcome to today's presentation. My name is Peter Youssef, Senior Market Analyst at IronFX. We are going to be mixing technicals and fundamentals once again. In front of your screens right now, you have gold's daily chart. We note the upward movement of gold aiming for the 2,685 resistance line, a level which was marked by the peak right here, which reversed the intense upward motion practically for over a month. So, for the bullish outlook to be maintained, we would require the precious metals price to actually breach the R1 2685 and start aiming for the record high level of the R2 2790. On the other hand, I would be noting that the bearish sentiment has been erased practically according to the RSI, which has breached slightly above the reading of 50. So it's right now at 52. That would be an indication that, on the one hand, the market's bearishness has faded away. On the flip side, though, it seems that there's still some bullish sentiment which should be built up before actually being more bullish on that. So, once again, I would like to see the RSI indicator rising, possibly reaching above the reading of 60 and start aiming for the reading of 70 in order to be more confident about the upward motion of the precious metal. On the other hand, we can see how there is an intense upward movement which goes way, way back. And if we turn to the weekly chart, there you go. There was a breach, but the price action of gold recovered. Back to the daily chart. So overall, we see the case for gold's price to remain in negative correlation with the US dollar. And I'm saying this despite a strengthening of the USD yesterday, which was also accompanied by a rise of gold's price. It's something which we may see coming into effect at a later stage. Moving now to the FX market and Euro USD. That's better. Now, Euro USD remains in a sideways motion between the 1.0490 and the R1 1.06. We tend to maintain the bias for the sideways motion to continue as long as the price action remains between the pre-mentioned levels. I would like to note that the S1 practically notes this true here, while the R1 the peak. On the other hand, we have the RSI indicator, which is pretty low. It's actually near the reading of 30. It's actually at 31.4, implying a rather strong bearish sentiment on behalf of the market for the pair, which could drive it lower. Yet, once again, for a bearish outlook, we would require the price action to breach the S1 1.0490 and start aiming for the S2 1.0360. Now, I have to note here that the price action of the pair hasn't been in such low levels for a long time. And let's have a look when was the last time there was an action on this. And it's 2022, end of November. So we're talking about 2-year lows should the S1 be broken. Now, for a bullish outlook is a remote for Euro USD, both on a fundamental as well as on a technical level. Nevertheless, it's still possible, and for the adoption of a bullish outlook, we would require the price action of Euro USD to rise, breach the 1.06, and start actively aiming, if not even reaching the 1.0755. Now, the possibility for such a scenario to materialize could be slim, but if we drill into the 1-hour chart, the picture tends to change in the following, that we may be seeing a drop and a reversal at a slow pace. Back to the daily chart. Let's have a look at USD JPY. JPY, which against all odds is strengthening, and this, what we're seeing here, the latest red candlestick, is not a weakening of the US dollar. It's mostly a strengthening of the JPY. And it seems to be related to BOJ's intentions. So at this point, definitely the 154.80 level has to be marked as a resistance line, given that the price action has breached below it. Let's also readjust the labels. 146.45 being set as the S3. The S2 being set at 149.10. And the S1 at 151.30. A level marked by this show here. Now, on a fundamental basis, JPY seems to be strengthening given BOJ stance. Starting off with BOJ Governor Weather. Now, Mr. Weather had mentioned last week in a rather balanced statement that the possibility of a rate hike in the December meeting is still on the table. And at this point, actually during today's Asian session, he mentioned that the bank will maintain a meeting-by-meeting basis of decision about its future moves. However, it would be also incorporating any FX moves. And as JPY weakened, that would imply practically that the possibility of a rate hike is coming nearer. And that was maybe the main reason behind the strengthening of JPY today. For the time being, we switch our bullish outlook. Why? Because the price action has breached the upper Bollinger Band, the upward trend line, and the RSI indicator is correcting lower. It's still above 50, but it's aiming towards that level. So that tends to imply that on the one hand, the upward motion has been interrupted, and on the flip side, and also furthermore, the bullish sentiment for the pair is easing, which could allow a correction lower. I would be also adding another technical issue, and that would be the fear of the pair to actually form a higher peak than this one. You can see that in the past movement we had one peak, a higher peak, a higher peak, another higher peak, a fourth higher peak, but afterwards the next one is lower. So practically we may be seeing some hesitation on behalf of the bulls to actually aim for the 158.35 resistance line. Mind you that the pair is already at relatively high levels for BOJ standards, so a market intervention is always possible, but definitely a correction lower by the market per se, I think would be preferable for BOJ. It's characteristic that BOJ policymakers are making practically verbal market interventions in support of the JPY in the form of a warning against speculative moves of the FX market to weaken JPY further. For the time being, given that the upward trend line seems to have been broken, we switch our bullish outlook in favor of a sideways motion bias, with the price action possibly rotating around the 154.80 level, the R1, For a bearish outlook, I would require the pair to drop, breach the S1 151.30 clearly, and start aiming for the 149.10. Okay, let's have a look at GBP USD. There is some hesitation on behalf of of pound bears, and relative stabilization, I may add, just below the 1.2675 resistance line. You can see it in the price action movement of the past 4 days. My best guess, given that the RSI indicator is pretty near to the reading of 30, it's at 32.5, I would expect the bears to regain control over the pair and see it aiming for the S1 1.2515. At this point, I would have to note that for a bearish outlook to be solidified, we would require a lower true than this one. And that would allow us practically for the downward trend line to be enhanced, given that we have one peak, then a lower peak, then we have another low peak. Okay, let's have a look at USD CAD. Now, USD CAD dropped over the past 2 days. That was Monday and Tuesday, yet bounced on the 1.3945 support line yesterday and rose. It was slight, but it's still there. I would expect that should we see additional bullish strength for the USD CAD, we may see it aiming for the R1 1.4080. Practically, the pair is in a make or break position in the following sense. On the one hand, yesterday's bouncing on the 1.3945 support line was also a bounce on the upward trend line, which has been guiding the pair since the, let's have a look, 25th of September. Should the pair stabilize, it would be breaching the upward trend line, which would be the first signal of an interruption of the upward motion. For the bullish outlook to be continued, we need to see the pair forming a higher peak than this one. So the price action has to rise and breach the R1 1.4088, peaking somewhere here. Now, the RSI indicator, though, on the other hand, has dropped considerably and is now at the reading of 56.5, which highlights the easing of the bullish sentiment among market participants for the pair, which could allow USD CAD to stabilize somewhat. That's why I'm highlighting this. For a bearish outlook, the bar is pretty high. The price action would have to drop, breach clearly the 1.3945, and start aiming for the 1.3820, if not even reach it. And a possible bounce back up to the S1 and then a correction lower would allow us for a head and shoulders formation to be formed, and that would be forcing the pair all the way down. For the time being, though, once again, stabilization seems to be in the cards for USD CAD. Moving to AUD USD. Now, AUD USD seems to have been correcting lower yesterday, yet today is holding out. The RSI indicator is at 41.9, which implies that there are still some bearish tendencies left within the market sentiment for the pair. Yet for a bearish outlook, the price action has to form a lower true than this one. So it has to breach the S1 0.6445. Also, the downward trend line tends to imply that the bears are still in control. It's going to be highly interesting to see whether the pair will be able to actually breach the S1. Should it not be able to breach the S1, then inevitably at some point it would be breaching the pre-mentioned downward trend line, and that would be forcing us to practically switch our bearish outlook in favor of a sideways movement bias, possibly between the R1 and the S1. For a bullish outlook, we would require the pair to rise, breach the pre-mentioned upward trend line, breach the R1 0.6555, and start aiming for the R2 0.6705. Let's have a look at USD CHF before we leave the FX market. We are now at, by the way, if you want to have a look at any trading instrument we provide, let us know in the chat box. And if we have time today, we could do it daily. If not, we can always do it on Monday. Now, the price action of USD CHF has moved upwards and corrected lower. Now, the big question is whether we are seeing here a second upward trend line which has been interrupted, like this. On the other hand, Boys at Research highlighted this, which is also quite interesting. In my opinion, I see the case for a possible stabilization of the pair. For the time being, the price action has broken the 0.8750, so that has to be turned into a support line. And let's see how high it can go. Once the R2, the 0.8920 level has been breached, the next one is the 0.9050, and even higher right here. You can see the peak here. We have the 0.9220. Moving the R2 at 0.9050. And the R1 at 0.8920. You can see how the upward motion on the 15th, on the 14th of the month, hitting a ceiling at the R1, practically validated the level as a resistance line. Why? Because it reversed or forced the pair to correct lower. Moving now the support lines, starting with the S1 at 0.8750, the S2 at 0.8555, and the S3 at 0.8370. For the time being, I see the case for the pair to stabilize a bit. On the other hand, we note that the RSI indicator is at the reading of 60.8, more or less highlighting that there's still some bullish predisposition on behalf of the market. Yet for a bullish outlook, as I have mentioned, I would require a higher peak than this one. So the price action has to breach above the 0.8920 and start aiming for the 0.9050. Let's have a look at WTI. We are going to be issuing a full report later today about oil. And for the time being, it seems that a sideways motion is being maintained, with the R1 being the upper boundary at 72.10 and the lower boundary being set at 0.6460. One could argue that it's actually a bit higher, somewhere here, as we have 1, 2, 3 touches at 66.45. That narrows down the movement of a sideways motion. And I think it's pretty clear how the sideways motion is also being supported by the fact that the RSI indicator is almost at the reading of 50, implying a rather indecisive market, while at the same time note how the Bollinger Bands have narrowed if compared to the week before. So all of that tends to imply the sideways motion is to continue between the R1 and the S1. For a bullish outlook, I would require the commodity's price to actually breach the R1 72.10 and start aiming for the R2 77.85. On the flip side, a bearish outlook to emerge, we would require the commodity's price to breach the S1 66.45 and start aiming for the S2 57.15. Now, I would like to have a look at the second support line. I think it could go a little bit higher if we find the nice true here. Yep, and we have it. Touched, aimed for. I'm keeping this. Sorry. At 61.45. Let's have a look at the S3 as well. Could go here as a resistance line, former resistance line. That would be at 54. Nice round figure. Let's correct the levers as well. The S1 stays as it is. The S2 is now $5 lower at 61.45. And the S3 at 54. $6. Okay. Let's have a look also at, I would like to have a look at US stock markets. And specifically NASDAQ. Okay, Nvidia's earnings report tended to disappoint, and I would be highlighting at this point mostly the forward guidance. We see that there is some bearish tendencies in NASDAQ that was started yesterday and today during the Asian and early European session. The drop is also evident in Dow Jones and S&P 500. So practically, despite US stock markets yesterday sending out some mixed signals, we had Dow Jones and S&P 500 remaining unchanged or rising slightly, and NASDAQ at the same time falling. We see that the drop during today's Asian and early European session is unanimous, which may be spelling trouble for US stock markets, equities. So we may see the downward motion being extended at the American Open. That would be an interesting opening today. Other than that, once again, Nvidia's earnings report tended to disappoint traders, and most probably we may see it weighing on its share price furthermore. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
high level of risk, and it is possible to lose all your capital, right? These products may not be suitable for everyone, and you should ensure that you understand the risk involved. All right, do take note of the disclaimer as well. The information in this webinar should not be considered investment advice or investment recommendation, but instead educational material only. All right, so my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, so today's webinar series will be the first part of the Fibonacci series. So we'll be looking at retracements. So we'll start off with the basics, of course. We'll look at how do we identify an ideal market structure? How is it different from something that's non-ideal? Why is that important? Because when we are trying to use the Fibonacci retracement tool, we should be looking for ideal market structure or something that resembles as closely as possible to an ideal market, right? Being the real life world, nothing's ever ideal when it comes to market structure or price action, but we are going to look for something that's going to be as close as possible to the ideal structure. Then we will look at how we can follow the market structure so as to achieve good or to achieve significant Fibonacci retracement levels, right? When we do not use the Fibonacci retracement tool correctly, and when we do not follow the market structure as closely as possible, then the retracement levels that are highlighted by the Fibonacci retracement tool will not indicate significant resistance or support levels, right? So that's the basics. We are going to identify what is an ideal market structure, what type of price structure in reality mimics the ideal market structure, and then how to follow that, and how do we draw the Fibonacci retracement from the starting point to the end point. Then we'll also look at the various Fibonacci retracement levels. Then we'll also touch on the negative Fibonacci levels as well as the levels that are greater than 100%. All right, so if you have any questions along the way, do not hesitate to drop your questions in the Q&A box or the chat box. I'll be more than happy to go through your questions should there be any doubts along the way. All right, so let's start off with the ideal market structure. What is an ideal market structure? Well, first of all, we'll start off by looking at what is wrong, right? Okay, so when we are trying to draw a Fibonacci retracement, we're looking for significant swings, right? So we're looking for market swings, so like a swing high or a swing low, right? In this example here, what we are seeing, this GIF is showing us an example of insignificant swings, right? So you can see here, I'll just label it, this is number one, this is number two, right? So swings like these are pretty insignificant, right? And also here, looking at here, three, this is a swing high, 4 and 5, right? When you look at 1, 2, or even this one here, let's label this 6. You can see this swings, all these swing highs here, these are the highs. They're all pretty insignificant. So we're not looking for these sort of insignificant swing highs, right? Similarly, when we look for the swing lows, you look here, A, B, C, D, right? These are insignificant swing lows, right? So we're not looking for this type of market structure where the swing highs and swing lows are insignificant. This is pretty noisy, right? To a certain extent. So what we're looking for in a market structure that will have significant swings. Now, this can be swing highs and swing lows, of course, right? So now that we've had an example of what is or what are insignificant swings, let's move on and try and see how do significant swings actually look like, right? Okay, now here we have a GIF showing us examples of how to identify significant swing highs and significant swing lows, right? As you can see here, we need to look for significant swing highs and lows. So clearly we can see here, point number one is a significant swing high. Point number two here is a significant swing low. Point three is another significant swing high. Point four is another significant swing low. 0.5 is a high, 6 is a low, 7 is another high, right? So this GIF is clearly illustrating how do we identify significant swing highs and lows in market structure, right? So you can clearly see this is a swing high here, 0.1, this is a low, high. Number 4 is a low. 5 is a high again. 6 is another low, and 7 is a high, right? So do take note. This is how, this is the type of market structure that we're typically looking for when we're trying to identify swing highs and swing lows, because that's very important. That's basically the main foundation of Fibonacci retracements. We need to identify the significant swing highs and swing lows so that when we actually use the retracement tool and we draw the Fibonacci retracements, we are going to get retracement levels that would actually function as, or that would potentially function as very significant resistance or support levels, right? So what we're trying to do is increase the probability of these retracement levels functioning as a significant support or resistance, right? If you don't draw the Fibonacci retracement in the correct manner, the subsequent retracement levels are very likely not to yield any significance, right? Be it as a support or resistance, okay? Right. Now, how do we follow the market structure, right? Now that we've identified significant swings, highs and lows, now how do we identify, how do we follow the market structure when we use the Fibonacci retracement tool? So as we can see in this GIF here, point 1 is clearly a significant swing low. That's fine. That's great. Point 2 is also a significant swing high. Point 3 is another significant swing low. And point 4 is another significant swing high. But in this example, they're drawing the Fibonacci retracement starting from point 1, but going all the way up to point 4. As you can see here, the highlighted diagonal line, right? You can see the highlighted diagonal line is going to come up again. Now that highlighted diagonal line in blue, that is the trend line of the Fibonacci retracement tool, right? Fibonacci retracement tool. So when we start a Fibonacci retracement, we always start from the left to the right. So when we're doing it for the upward part of the move, we're always going from bottom left to top right. Similarly, when we draw the Fibonacci retracement for the downward move, we're going to go from top left to bottom right. So do take note, this is another key aspect of how to use the Fibonacci retracement tool. We always go from left to right. So if it's an uptrend, if market structure is going up, right, we always go from point 1 on the bottom left to point 2 on the top right. Similarly, when we have a market structure that's showing a strong downturn, we're going to go from point 3 to point 4. That means we're going to go from top left to bottom right. Remember, Fibonacci is always left to right. Yeah. Whenever we are drawing the Fibonacci retracement tool, be it for the upward move or the downward move, we always go from left to right. So for the upward move, for the uptrend, we're going to go from bottom left to top right. And for the downtrend, we're going to go from top left to bottom right. Okay, that's another key aspect of using the Fibonacci retracement tool. All right, now going back to that trend line, remember I was talking about that can you see here, this highlighted in blue, this trend line. Now in this example, they've started this Fibonacci retracement starting from point 1 and ending it at point 4. We can clearly see that the trend line is not capturing the market structure at all, right? We can see that there's plenty of gaps to the top of the trend line as well as to the bottom of the trend line. So in this type of market structure, the ideal Fibonacci retracement, right, to be drawn would be from point 1 to point 2. So when we draw it from point 1 to point 2, we can see that the trend line will capture the market structure much better than from point 1 to point 4. Similarly, when we're doing it for the downtrend, we'll start from point 2 to point 3. And when we do that, the trend line will capture the market structure very closely. So that's what we're looking for. We're looking for the trend line to capture the market structure as closely as possible, be it to the upside or to the downside. So that's how we know whether we've drawn the Fibonacci retracement using the correct starting and ending points. Do take note, if the trend line does not capture the market structure very well, that means it's quite likely we have not used the ideal starting and end points for the Fibonacci retracement, right? Okay, let's go on to the next slide. Now here, we can see we've identified point 1 and point 2. Point 1 is the starting point, point 2 is ending point, and you can clearly see that the blue trend line has captured the market structure as closely as possible. Of course, there are going to be a little bit of gaps to the downside and to the up of the trend line, but in general, we can see that this trend line has captured the market structure very well. Now, similarly, if we had drawn the Fibonacci retracement from 0.0 to 0.1 here, right, we would have seen that the trend line would have captured this market structure very well as well, right? Would have captured this market structure pretty well, right? So this is what we are trying to emphasize and highlight. So be it for an uptrend or a downtrend, Fibonacci retracements, we always go from left to right. For the uptrend, so bottom left to top right. And for the downtrend, we start the retracement from the bottom top left and we end at the bottom right. Right, and the other aspect to take note of, or the important point to take note of, is the trend line must capture the market structure as closely as possible, be it to the downside or to the upside. All right, great. Okay, let's move on to the next slide. All right, so now that we've had a quick look of how to identify ideal market structure, how to identify significant swing highs and swing lows. And also, we've also seen how to draw the Fibonacci retracement in a manner that is going to give us significant retracement levels, right? We saw we have to identify significant swing lows here. You can see 0.0 is a significant swing low. 0.1 is a significant swing high, and 0.2 is another significant swing low. And similarly, when we choose the most ideal starting and end points, the blue trend line is very likely going to capture the market structure very closely, right? So do take note of that. All right, okay, with that, now we're going to look at the various Fibonacci retracement levels. Okay, for those of you who may be aware or have used the Fibonacci retracement tool before, so we know that this goes from 0 to 100, right? 0 to 100%. Right, so the retracement levels, as highlighted here, as you can see, or well, not highlighted, but as described in this image, you can see that the retracement levels run from 0% to 100%, right? So the key retracement levels are at 23%, 38.2%, 50%, the golden ratio of 61.8%, and the 78.6%. So there's 1, 2, 3, 4, 5 key retracement levels, right? So when we talk about the Fibonacci retracement levels, we're talking about the 5 key retracement levels running from 0 to 100, and they are, right, 23%, 23.6% to be precise, right? 38.2%, 50%, 61.8, which is the golden ratio, of course, and we end up with 78.6%, right? So do take note, these are the 5 key retracement levels: 1, 2, 3, 4, 5. 23.6%, 38.2%, 50%, the golden ratio 61.8%, and of course the 78.6%. Now, in this example, we have started this retracement from 0.1, the starting point 0.1, right? And the ending point 0.2. So do take note, Fibonacci retrace, the starting point of the Fibonacci retracement will always indicate 100%, and the ending point will indicate 0%. So conversely, if I were to draw the Fibonacci retracement from this part here, let's just identify this swing low as 0.4. Now, let me just tidy this up a little bit. Right, let's just identify this swing low as 0.3 and this swing high as 0.4. So when I draw the Fibonacci retracement starting from 0.3 to 0.4, my starting point is going to show me 100%, and the ending point is going to show me 0%, right? Just like how we see here on this downtrend, right? On the downtrend, we start from top left and we end at bottom right. Conversely, for the uptrend, we start at bottom left and we end at the top right. So starting point is always 100% and ending point is 0%, right? And the key retracement levels, like I said, are the 5 key retracement levels at 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Now, in this example, we're also showing Fibonacci levels that are greater than 100% and lower than 0%, right? So the negative retracement levels are the key retracement levels at the negative point are negative 27.2 and negative 61.8%. We'll touch on this a little later. Similarly, extension levels that are greater, Fibonacci levels that are greater than 100%, the key levels are at 127.2% as seen here, and what is not seen is at 161.8. But for now, let's just focus on the retracements, right? So 23 to 78.6, right? So as I mentioned, we started at 0.1. We started this retracement, right? We started this retracement at 0.1, 100%, and we end at 0.2, which is 0%, right? So we can only start this once the price has formed the swing low. So basically, we're waiting for price to make this significant swing low here, come up here, maybe the first after the first 1 or 2 candles or 3 candles, depending on your time frame. Let's just assume we are on the 4-hour time frame and we see 2-3 candles, at least 1 or 2 candles being formed after we see the significant swing low. That's when we can draw the retracement. So in this case, we're drawing the retracement from 0.1 to 0.2, and what the subsequent retracement levels at 23, 38, 50, 61, and 78.6, what these levels are going to highlight. These levels are what these levels are going to highlight are potential resistance levels. Do take note when we draw the Fibonacci retracement for a downtrend like this, the subsequent retracement levels are going to help us identify potential resistance levels. All right. Conversely, when we draw the Fibonacci retracement for the uptrend, right, we're going to start from 100% and at 0. What the subsequent retracement levels tells us is going to highlight to us is our potential support levels, right? So we get 23.6%, 38.2%, 50%. So for the uptrend, the retracement levels are going to highlight potential support levels. And for the downtrend, the retracement levels are going to highlight potential resistance levels, okay? Right. So as you can see here in this example, 23.6% didn't offer much resistance, right? You could see price just stalling briefly here before going higher, where it does seem to have run into resistance. Okay, then after that 38.2%, we can clearly see price breaking above 38.2% as well, where price failed to break above is at the 50% retracement, right? Clearly, we can see here price has failed to break above the 50% retracement. So this is a major resistance for price for this current example. So we can see just because we have a retracement level at 23.6% and 38.2% does not mean that price is going to stall at this level and reverse and drop lower, right? They are just points that are going to help us identify potential, right? What is important here, they are highlighting potential resistance levels. It doesn't mean that they will act as significant resistance levels, but what the retracement levels here are going to highlight is they're highlighting potential resistance levels. But in this example, you can clearly see 23.6% and 38.2% did not offer any major significant resistance. Where price did stall was under the 50%. So now we know for that 50% is a significant resistance level and is going to take something pretty like a strong catalyst for price to break above this level. All right, so do take note. The retracement levels highlight potential support or resistance. They do not indicate or they do not guarantee that these retracement levels are going to function as very significant support or resistances, right? Do take note. That's a very important, another important aspect of using the Fibonacci retracement tool. All right, okay. Moving on. All right. As I mentioned, the key retracement levels are 23, 38, 50, 61, and 78. Levels that are lower than 0. We also have Fibonacci levels that are lower than 0%. And we have Fibonacci levels that are higher than 100%. So we're going to get to those as well. All right, so the negative Fibonacci levels, right? So the negative Fibonacci levels are also known as expansion levels. You can see the key negative Fibonacci levels are at negative 27%. and negative 61.8%, right? These levels, these negative levels are also known as expansion levels, all right? So you may hear or come across this term, so do not be confused if you come across the term Fibonacci expansion or expansion levels, right? They simply refer to the negative retracement of negative levels, which are at negative 27.2 and negative 61.8. All right. Okay. So these are the key retracement levels for the negative at the negative end, and they are also known as expansion levels. Now, how can we use this? Okay. Uh, how can we use these expansion levels? Well, first, right, you can see we started this retracement from point 1 here, and we ended at point 2, right? And we can also see 50% is here. So in order to use the negative levels, or not rather to use, but for the negative levels to provide or to function as significant support levels, we actually need to see price retrace up to at least 50 to 61.8%, right? Do take note, price must retrace, right, after forming this low here, this significant swing low here. Price must retrace to at least 50% or even better 61.8%, so that when we see a market structure like this, and then should price reverse and drop lower, breaking under the 0% or the ending point, that means that these negative levels are expansion levels at negative 27.2 and negative 61.8% Fibonacci are going to potentially function as significant support levels, right? So do take note, this is another key aspect when using the expansion levels. The Fibonacci, the market structure must retrace up to 50 to 61.8%. It must, right? So at least 50%, and then should price reverse and drop lower, breaking under the ending point, that means negative 27.2 and negative 61.8 are going to potentially function as significant support levels, okay? This is a very important aspect, because if price only retraces up to 38.2% and then stalls and reverses to drop lower, that means this levels here at negative 27, negative 61 may not offer significant support, right? Do take note. This is one key criteria, right? The key criteria is the retracement has to come up to at least 50%, right? The retracement has to come up to at least 50%. I'm talking about this retracement here, right? It has to retrace up to at least 50%, even better if it comes all the way up to 61.8. And then as it reverses to drop lower, the expansion levels are then likely to function as significant support. All right. Okay. Now, in this example, we can see clearly that price has retraced to 50 and has even reached 61.8%, right? And then has now started to reverse and drop lower. Now, so how can we use these expansion levels? First off, as price starts to retrace to drop lower, we can also use the 0%, for example, as a potential take profit level, right? So if you go short on this position here and price is reversing, right? Perhaps there's a strong bearish catalyst that has a combination of a strong bearish catalyst, and your technical analysis is telling you this is now a potential short entry, where you would identify your take profit would be potentially here at the major swing low here at 0%. And should price continue to break lower, you can identify your second TP or take profit at the negative 27.2%. So, right, this is where we can this is how we can use the negative Fibonacci levels or the expansion levels to help us identify potential take profit levels for the short side, right? So in this example, you're seeing it for the short side, for a potential short trade, right? So typically, um, in this scenario, price will, if price breaks below this swing low here, it will typically find support at negative 27.2%. And usually it does bounce off this level to return to 0%. So do take note. So this is how we can use the negative 27.2% Fibonacci expansion level to help us identify a potential take profit on the short side or for the potential short trade, right? Okay. Um, with that, okay, now we're going to look at Fibonacci levels that are greater than 100%, right? The key Fibonacci levels that are greater than that are greater than 100%, as I mentioned earlier, at 161.8 and also at 127.2%, right? These are the two key significant retracement levels. Sorry, extent levels that are greater than 100, and these levels that are greater than 100, they're also known as Fibonacci extensions. All right, do take note. Right, so if you come across the term Fibonacci extension levels, it is simply referring to levels that are greater than 100%, and they're specifically referring to 127.2% and 161.8%, right? Just like for the Fibonacci expansion levels. So similarly, if you come across the term Fibonacci expansion levels, they're referring to levels that are the negative levels, and specifically referring to negative 37.2 and negative 61.8. Okay, so expansion levels are negative, also known as the negative Fibonacci levels, also known as Fibonacci expansion levels, and the Fibonacci levels that are greater than 100% are also known as the extension levels. And the key extension levels come in at 127.2 and 161.8%. All right. So in this example here, right, we see price from this starting point here, point 1 making the swing high here, and then point 2 has made the swing low here. So how we can use the extension levels is we can use these extension levels to help us identify the take profit, potential take profit zones. Sorry. So in this case, you can see price has made this Nike tick structure. You can see this Nike tick structure, right? We all know the company Nike and its logo, which is the tick. And you can also clearly see a price. This market structure here is following this Nike tick structure. So what we see is, or how we can use the extension levels, is when we see price reverse strongly and come back up to the starting point, which is at 100%. Here we can say we're looking for potential bullish breakout here, right? We have our technical indicators telling us that this is a strong bullish move. We also have a strong fundamental data catalyst that's driving this move as well. So we are looking for potential bullish breakout. So when price breaks above 100% here, how we can use the extension levels is we can use them to identify potential take profit. So for example, 161 here has been identified here, and 127 is probably somewhere around here. So we can use these extension levels to identify potential take profit. So this could be the second take profit zone, whereas the 127.2% would be the first take profit zone, right? So this is how we can use the extension levels to help us identify potential take profit zones should price break above the 100% or the starting point and continue to drive higher. And then from here is where you could potentially is to identify a major resistance level. And from here, you could also potentially initiate a short trade idea as well. Because when you see price failing to break above the 161.8% extension level, it is quite likely it is going to drop lower. So as price moves away from this extension level and starts to drop lower, you can initiate a short entry, and your stop loss will be placed slightly above the 161.8% Fibonacci retracement to give us a little bit of a buffer, right? To give us a little buffer. So should price retrace back to the 161% as you can see here, but because we've kept our stop loss slightly above the extension level at 161%, it allows us to remain in the trade, and should price continue to drop lower, we can benefit from this potential short trade idea as well. So you can see how the extension levels can be used to identify potential take profit zones to the upside. And then once it hits 161.8% Fibonacci retracement extension, and then it starts to pull away, you can also consider initiating a short trade idea where you put the stop loss slightly above the 161.8% Fibonacci extension. All right. Okay, great. Let's see. Right, okay. we've come to the end in terms of my slides. So what are we going to do? What we are going to do now is we are going to move over to trading view and try and find examples of how to use the Fibonacci retracement tool correctly, right? So we're going to start, of course, just start off with the basics. All right. Okay. So here I am on trading view. I'm on the 4-hour time frame, and I'm going to use the dollar index as an example, right? So first of all, we're going to try and identify significant swing highs and swing lows. So let's just do this exercise together, right? So just to take note, when we are using Fibonacci retracement tools, they generally work better on the higher time frames, right? So they generally work better on the 1 hour time frame and above, right? You can use them on the lower time frames as well, 30 minutes, 15 minutes, but they may not offer the same level of support or resistances as when we use them on the higher time frames. So do take note uh, about this aspect of using Fibonacci retracements, right? They do tend to work better on the higher time frames, such as 1 hour and above. All right. Okay, so first of all, we do a simple exercise on trying to identify significant swings, right? As we saw in the slides earlier, right? We saw examples of insignificant swings, and now we're going to look at examples of significant swings. So this is I'm on a 4 hour time frame for the dollar index, DXY. My chart is showing the price structure from end of September all the way to present time. So I think it's quite clear by now where the significant swing lows and swing highs, right? So, right, you can see here this is a significant swing low here. Okay, maybe hang on. Right, let's start off with swing highs. We can see this is a significant swing high. This is also another significant swing high here. This is another significant swing high. This is another high. This as well. This as well here, right? So 1, 2, 3, 4, 5, 6, right? These are generally how we would identify significant swing highs, as this one here as well. So the red circles are, I'm highlighting the significant swing highs in red. And now I'm going to highlight the significant swing lows in green. So you can see here, this is a significant swing low. This is another swing low here as well. Here, 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 and of course here, right? So what we're actually trying to look for, right, is I'm going to now just use a different color. So we're going to look for significant swings, right? So you can see when price makes a very strong V-shaped move here like this, as highlighted in the orange line, right? We can see that this is a very significant V-shaped move, right? And this tells us this is a significant swing low, and this is a significant move. Similarly, right, when I draw the swing high from here, we can see this is an inverted V shape, right? We can see a very clear, significant swing high with a strong inverted V shape as well. Similarly, for this downside, we see a strong V shape here. And then for this swing high here, we can see generally the pattern I'm trying to get at. You can see that this is another inverted V. Similarly here, this is a strong V shape pattern here, swing, another strong inverted V shape here, another strong inverted V shape here, strong V-shaped pattern here to signify the significant swing low. Another one here, inverted V-shape to indicate the swing high. Another strong V-shaped pattern here to indicate the swing low. And this high here, low here, high here as well. This is also a pretty significant swing low bounce here. And of course, this significant swing low over here. Right, so you can clearly see how we can identify major swing highs and swing lows, right? That's important, right? So as you can see here, I'm just going to leave this on for a bit before I erase it. So you can clearly see the green circles highlighting the significant swing lows, whereas the red circles are highlighting the significant swing highs. And you can see by my orange uh, V shapes as well. We see an inverted V shape as well as the regular V shape that show us the size of the move, right? We're looking for significant swings and lows and highs, and the size of the move can be is highlighted by my orange brushes, right? You can see that the moves are very significant. So this is how we identify swing highs and swing lows, so that we are able to identify ideal starting and ending points for the Fibonacci retracement, right? Okay, so now I'm going to clear all of this, and I'm going to show you how we can draw the Fibonacci retracement for these on these swing highs and swing lows. All right, so we'll start with here on 29th of September and we'll end here on 3rd of October. Okay, so for those who may not be familiar with the Fibonacci retracement tool, the icon looks something like this, right? So you'll see 4 lines, and you'll have the bubble here as well, the circle here on the left and on the right. So if you highlight it, it'll show you, uh, depending on whatever platform you're using, but if you're using a trading view, right? If you highlight over this icon here, it'll tell you Fibonacci retracement. So that's what you want to use. So we click on that, and we're going to start with the absolute low point here. Okay. So I'm just going to zoom in a little bit. Right. So I'm going to just zoom in a little bit. This is my starting point, right? So remember, for this is an uptrend. So Fibonacci retracement always goes from left to right. Since this is an uptrend, we're going to start from the bottom left and we'll end at the top right. Okay, I'm going to pull up all the Fibonacci levels here. So this gives me the negative levels, the positive levels. Remember, negative levels are called expansion levels, and levels greater than 100 are called extension levels. Okay, right. Okay, but with that, I'm just going to focus on the retracement levels in this example, right? So as not to overcomplicate things. So I'm going to get rid of the extension levels as well as the expansion levels, right? And we're just going to deal with the retracement levels going from 0 to 100%, right? So then this is much more clear. So when we draw the Fibonacci retracement from this uptrend here, bottom left to top right, and as price is coming down, these retracement levels are going to potentially are going to highlight potential support levels, right? Now, whether these levels truly function as significant support levels, we can only tell when the move plays out. But generally, it does help us to identify potential support areas. So as price has made this swing high here and started to come down, we can see that price did find decent support at a 23.6%, retracing higher before falling lower. Then again, you can see here, it did find a little briefly found support here at 38.2%, again at 50, then also pretty strong support here, 61.8%, 78, and then finally 100 down here, right? So you can see clearly in this example here, price did seem to find support at almost nearly every single retracement level. Now, this doesn't always happen to be the case, right? As we saw in the slides, right? There can be cases where price will just simply break through the 23, 38, maybe even the 50, and then find support at the 61.8%. So do take note, in this example here, we do see price to have clearly found support at each of the retracement levels, right? Okay, this was an example for the uptrend. Now I'm going to draw a Fibonacci retracement for the downtrend, right? So this was the uptrend, bottom left to top right. We can clearly see here, this is a strong move down. We have a nice significant swing high here on 3rd of October, and we have a significant swing low here on the 12th of October, right? So we're going to start this retracement from here. Remember, whether it's an uptrend or downtrend, we always go from left to right. So since this is a downtrend, we'll start from, hang on. We'll start from the top left and we'll end down here on the bottom right. So in this example, we can clearly see price has broken through 23, 38, and 50% very easily, right? Very easily. These retracement levels here did not offer a hint of resistance at all. Where it did finally run into resistance was at 61.8%, right? And then after that, over the next half a day or so, price briefly broke above the 61.8 as well before dropping lower. So you can see where price found major resistance in this example is at the 61.8%. Do remember over here when we did the Fibonacci retracement on this uptrend here, we could see price finding support at every single retracement level. However, for this part of the move, we can see where the the only level that offered serious resistance was at the 61.8% Fibonacci, right? So you can clearly see no two Fibonacci retracement is going to behave the same way, right? We are never going to see the same retracement levels functioning as a major support or resistance, right? Every swing high and swing low, or every uptrend and downtrend is going to be different, right? So do take note of that. There's nothing set in stone with regards to the Fibonacci retracement levels. It could be a case where the retracement levels offer support or resistance at every single level, or there could be a case like what we're currently seeing, where only the 61.8% has offered significant resistance. All right. Okay. So here we can see the price running into resistance 61.8 on 12th of October, 13th of October, as well as 19th of October, right? Okay, so these were the two examples of how we can use how we can draw the Fibonacci retracement for an uptrend and downtrend. All right. Okay. Now let's move over to somewhere to where price is currently trading. Right. Let's see where price is currently trading and perform some technical analysis here using the Fibonacci retracements. All right. Okay. So once again, before we try and draw the retracements, let's do a simple exercise where we can try and identify the significant swings, right? Okay, so this is a green. All right. So we can see here, this is a pretty significant swing low here on 29th of November. Another significant swing low here on 15th of December. This significant swing low here on 28th of December. So when we look at end November till now, we can see three significant swing lows when we're on the 4-hour time frame. All right. Okay, now I'm going to try and identify significant swing highs. Right. You can see here, this portion here is a pretty significant swing high here. And over here, okay, price has not yet played out, but you can generally see the top of this wick is another significant swing high as well. Right. Okay, so let's just say, okay, let me just okay, I'm just gonna highlight my points so it's easy to refer to as well. All right, so let's work with points 1, 2, and 3 first. All right, let's work with the first 3 points. All right, so we have identified our major swing highs and swing lows. But let's just focus on the first 3 points. So for this upward trend here, we would be actually technically we would have highlighted this as 0.2 because as price was pulling down, we have highlighted this as 0.2. So we'll take this in step by step. So we'll start the retracement for this uptrend here from 0.1 to 0.2, right? You can see here in this example, as price was pulling back, 23.6% did not offer any support at all. 38.2 not really, because we can see the wick extending way beyond the 38.2 and even dipping below the 50%. So where it did find support here in this example was around the 50% Fibonacci retracement, right? Because we can see here the body of the candles actually closing underneath the 38.2%, and we can also clearly see the wick extending beyond the 50. So where price did find support in this example was at 50% before going higher. And as price comes up here, right, when a new high is made, we cannot use 0.2, the original 0.2 anymore. If we do wish to use the Fibonacci retracement, we have to move our ending point now because this is a new high. We have to move it to here. which is, yeah. And in this sense, you can see uh the trend line, right, is capturing the market structure quite well, right? Is not in what is not as ideal, as perfect as what we saw here at the first go. You can clearly see the trend line has captured the market structure very well. But even when it makes this second high here, you can see that the trend line has captured the market structure quite well. So we can still use this. So similarly here, 23.6% did not offer any support. Where it did find support was this time round at around the 38.2 before retracing higher and then finally smashing through all the other levels. You can clearly see here as it smashed through 38.2, 50%, 61% offered no support. Where it did find support briefly was at around the 78.6% Fibonacci retracement. All right, you can clearly see how the retracement levels help us to identify potential, right? The key word here is potential support levels or potential resistance levels, right? Nothing is set in stone. It doesn't mean price has to react off each level, but it's just helping us to identify potential support or resistance levels. Okay. Now, after price has come down here, it has found support around 100 and 190 before proceeding higher. So now we have 0.2 and 0.3. We can also run a Fibonacci retracement on this downturn. So we'll start from here, 0.2, 11th of December, going down to 0.3, which is the 14th of December. So in this case here, we can see as price was retracing higher, these retracement levels are helping us to identify potential resistance areas or zones, but we can clearly see 23.6% offered no resistance. Where it did run into resistance was around the 38.2%, right? 38.2% was where price found resistance before dropping lower. And you could see from 18th December all the way till 3rd of Jan, right? This price failed to break above this level until just recently last week. Okay, so this is how we can use the levels here. Now, as price comes down here, right, we can see now this, I would use this as let me highlight this as 0.4, right? So you can see here, this is a pretty significant swing high. This is a significant swing low. So if I were to extend this Fibonacci retracement, right, I go from 2 to 4, right, we can see that the market structure, the trend line has captured the market structure quite well, right? Quite well. Some would argue that because this has drifted too far, I would not use 0.2 as a starting point, but rather I would try and use 0.3 here, for example, this point here. Okay, here the market structure, the trend line captures the market structure a little bit better, but even here, I think to me, this is still pretty all right, right? This is still pretty all right here. You can see at this part, especially the beginning of the move, the trend line captures the market structure very well. And the second half of the move, it captures it pretty well as well. It's only this bit here. So as price is retracing higher, we can see clearly 23.6, 38.2, and 50% retracement levels offered no resistance at all. Where it did run into resistance was around the 61.8% Fibonacci retracement, right? So you can see here, these retracement levels are just going to help us identify potential resistance, but you actually have to see where price is actually going to run into, right? So you can see here, because this is also an overlap, a pretty strong resistance level here, right? As price retrace higher here in 18 December, this forms a pullback resistance, right? This forms a pullback resistance level. And you can see price actually running into resistance here on 3rd of Jan, right? It broke above 23, 38, and 50 very easily, but it actually stalled at around this resistance level here at 102.64. And also we can see how the 61.8% Fibonacci retracement has also helped us to identify another strong resistance zone above this pullback resistance. Okay. And now, okay, I'm going to label this as 0.5. So in this case, I'm going to run the Fibonacci retracement from 0.4, this swing low, ending with this high here at 0.5. Now, as price is let me get rid of this. Right now, as price climbed as high as or briefly going above 103 and then pulling back sharply, you can see that as it was falling down, 23.6% offered no resistance. 38.2 is a level where we did find a little bit of resistance, right? But actually, you can see it actually go beyond. So where it found support, where it found support was slightly above 50%, right? So the major support for the dollar index now is actually at around 102.10. And we can also see that 50% is also still suggesting another strong support zone should price break underneath 102.10, right? So do take note, these are the key support and resistance levels of course, now with price breaking above it, I would have to adjust my resistance to this level here. I'm going to use the body of the candle so we can see the major resistance at 102.74 and major support at 102.10. All right. So so we've covered Fibonacci retracements today, which is part 1 of the Fibonacci series, masterclass series. Right. So do look out for part 2 coming up next week. Right. So where we'll be building on retracements. Right. We covered a little bit of extensions and Fibonacci expansions today as well. Do take note, expansions are the negative levels and extensions are the levels greater than 100. We covered a little bit of that as well. And in part 2, we're going to delve a little bit more deeper into them. All right. So just to recap, today we had Fibonacci retracements. Do remember we're looking out for significant swing highs and swing lows, right? Such as these, right? We're looking out for significant swing highs and lows. Where did it go? Where's my brush? Right. Such as these, right? This is a significant swing low. This is a significant swing high. Another significant swing low. Also another significant swing low and swing high. So do take note. It is important to identify a good or ideal market structure where we can clearly see the significant swing lows and the significant swing highs, so that when we draw the Fibonacci retracement tool, we're actually going to get indication that these retracement levels are going to offer significant support or resistance. And do take note that the trend line has to capture the market structure as closely as possible. All right. Okay. So we've come to the end of today's webinar. Thank you all for tuning in. Do look out for next week's Fibonacci series part 2, right? And do register for that as well. All right. Take care. Have a great trading week and enjoy your weekend as well. All right. Thank you, everyone. And I'll see you guys next week. All right. Take care.